Ladies and gentlemen, welcome to Asian Guy Analysis on 16th of January 2026. Today, silver price fell back to about $90.66 per ounce after a big rally in recent sessions. Many investors are asking, why did this drop happen so fast and what triggered it? In this video, we break down the real reasons behind today's move using verified data and market context. Today's movement in the silver market caught attention because it came immediately after a powerful rally. Spot silver prices pulled back to around $90.66 per ounce, marking a clear pause after several sessions of strong gains. While the move may appear sudden to casual observers, it fits well within normal market behavior, especially after an asset rises sharply in a short period. Earlier in the week, silver had climbed to record levels, driven by a mix of macroeconomic expectations and strong investor positioning. When prices rise that quickly, markets often reach a point where buyers step back and sellers begin to emerge. This process is known as profit-taking, and it is one of the most common reasons for short-term price declines after a rally. Profit-taking does not mean investors have lost confidence in the asset. It simply means that traders who entered at lower prices choose to secure gains rather than continue holding through uncertainty. In silver's case, the rally was fast and extended, which increased the likelihood of a pullback once new data entered the market. Another important aspect of today's move is that silver was not alone. Gold and other precious metals also traded lower. This broader decline across metals signals that the move was driven by macro conditions, not by silver-specific news such as supply disruptions or industrial demand shocks. When multiple metals move together, it usually reflects changes in currency markets, interest rate expectations, or overall risk sentiment. Despite today's decline, it is important to put the price action into perspective. Silver remains significantly higher than where it traded earlier this month and well above levels seen in previous periods. That means today's move did not erase the rally. Instead, it adjusted prices after a period of rapid upward movement. From a technical standpoint, markets rarely move in a straight line. Strong trends are often followed by periods of consolidation or retracement. These pauses allow the market to absorb gains and reassess incoming information. Silver's drop to around 90.66 fits this pattern closely. Liquidity conditions also play a role. As prices move higher, trading volumes can increase and volatility tends to rise. This creates opportunities for short-term traders, hedge funds, and algorithmic strategies to exit positions quickly once momentum slows. These exits can amplify price moves in the short run, even without dramatic changes in fundamentals. Another factor behind today's action is timing. The pullback occurred as fresh U.S. economic data was released. Markets are highly sensitive to new information, especially data that affects interest rate expectations and currency strength. When data contradicts the assumptions that fueled a rally, prices often react immediately. It is also worth noting that silver has a reputation for sharper moves compared to gold. Because silver markets are smaller and less liquid, price swings can be more pronounced. This makes silver more reactive during periods of shifting sentiment, which helps explain the size of today's move relative to other metals. For different types of market participants, today's price action carries different meanings. Short-term traders may see it as a correction or a potential trading opportunity. Longer-term investors may view it as noise within a broader trend. Neither interpretation is inherently wrong. The key is understanding the context. Importantly, there was no indication today of structural damage to silver's market fundamentals. Supply dynamics remained unchanged. Industrial demand expectations did not suddenly weaken. There were no major geopolitical shocks related to silver-producing regions. The move was driven by financial factors rather than physical market stress. This distinction matters. Price declines, driven by fundamental deterioration, tend to be deeper and longer lasting. In contrast, declines driven by positioning, profit-taking, and macro reassessment are often shorter term and more controlled. Market sentiment also plays a psychological role. After a strong rally, expectations become elevated. When prices fail to move higher immediately, disappointment can trigger selling even in the absence of bad news. This sentiment shift often reinforces technical selling levels. Another point to consider is that many institutional investors rebalance positions on a regular basis. When an asset outperforms within a portfolio, it can become overweight. Portfolio managers may then reduce exposure to maintain balance. This type of selling is mechanical, not emotional, but it still impacts prices. Looking at today's move through this lens, silver's decline appears less alarming. It reflects a market adjusting to new information, managing risk, and digesting recent gains. These processes are part of healthy price discovery. Finally, it is crucial to avoid drawing long-term conclusions from a single session. One day's movement does not define a trend. Markets evolve over time, and short-term volatility is a feature, not a flaw, especially in commodities like silver. In summary, what happened to silver today was a measured pullback after a sharp rally, influenced by broader market dynamics rather than negative silver-specific news. Prices remain elevated compared to recent history, and today's move fits well within normal market behavior following rapid gains. Silver's decline today was not driven by a single headline or unexpected shock. Instead, it was the result of several interconnected macroeconomic factors that shifted market expectations in a short period of time. Understanding these drivers helps explain why silver pulled back after such a strong rally. The most important factor was stronger than expected U.S. economic data. Recent reports related to employment and economic activity showed that the U.S. economy remains resilient. When data points suggest strength rather than slowdown, markets quickly reassess their assumptions about monetary policy. This directly affects interest rate expectations. Over the past weeks, part of Silver ES rally was supported by the belief that the U.S. Federal Reserve might begin cutting interest rates sooner. Lower interest rates tend to support precious metals because they reduce the opportunity cost of holding non-yielding assets like silver. However, when fresh data indicates that the economy is still performing well, the urgency for rate cuts diminishes. Markets begin to price in the possibility that interest rates may stay higher for longer. Even a small shift in these expectations can have an immediate impact on precious metals prices. As rate cut expectations eased today, the U.S. dollar strengthened. This is a critical link in the chain. Silver is priced in U.S. dollars on global markets. When the dollar rises, silver becomes more expensive for buyers using other currencies. That can slow demand and put downward pressure on prices. Historically, there's a well-established inverse relationship between the dollar and precious metals. While this relationship is not perfect, it often becomes more visible during periods of sharp moves in currency markets. Today's dollar strength was enough to weigh on silver prices. Another contributing factor was profit-taking after an extended rally. Silver had gained rapidly over a short period, attracting both institutional and retail interest. When prices rise quickly, many traders choose to secure profits rather than risk a sudden reversal. This selling is not driven by fear or negative fundamentals, but by risk management. Market positioning also mattered. As silver rallied, positioning became increasingly crowded. When too many traders are on the same side of a trade, even neutral news can trigger a pullback. In such situations, markets become more sensitive to changes in macro signals such as economic data or central bank expectations. In addition, broader risk sentiment played a role. Signs of stability in financial markets and easing concerns in certain geopolitical areas reduce the immediate demand for safe haven assets. When investors feel more comfortable taking risk, they often shift capital away from defensive assets like precious metals. It is important to note that today, S move was not caused by changes in physical supply or industrial demand for silver. There were no reports of mine disruptions, no sudden drops in manufacturing demand, and no structural changes in the silver market. This reinforces the view that the decline was driven by financial and macro factors rather than physical market weakness. Another layer to consider is the role of algorithmic and technical trading. Many trading systems react automatically to changes in the dollar, bond yields, and economic data releases. When certain thresholds are crossed, these systems can execute sell orders rapidly, adding to short-term price pressure. Bond yields also influenced today's move. As expectations for rate cuts declined, yields moved higher. Higher yields increase the appeal of interest-bearing assets compared to metals, which can further reduce demand for silver in the short run. Psychology cannot be ignored either. After a strong rally, expectations tend to rise. When prices fail to continue higher immediately, disappointment can lead to selling, even without negative news. This emotional response often reinforces technical pullbacks. Crucially, none of these factors point to a long-term breakdown in silver's fundamentals. They explain why prices fell today, not why silver would necessarily continue falling. Markets constantly adjust to new information, and today's data simply shifted the balance of short-term expectations. In summary, silver fell today because strong U.S. economic data reduced expectations for near-term rate cuts, strengthened the U.S. dollar, and encouraged profit-taking after a sharp rally. These are normal forces in commodity markets and reflect a reassessment of short-term conditions rather than a fundamental change in silver's outlook. To fully understand today's pullback, it is necessary to look at the conditions that fueled silver's rally in the first place. The recent rise in silver prices was not random. It developed over time as market expectations shifted in favor of precious metals. One of the main drivers behind the rally was growing optimism around U.S. monetary policy. In earlier sessions, inflation data appeared to be cooling, which encouraged the view that the Federal Reserve could eventually move toward interest rate cuts. Even the possibility of easier policy tends to support precious metals, including silver. Silver benefits in such an environment because it does not offer yield. When interest rates are expected to fall, the opportunity cost of holding silver decreases. This makes it more attractive relative to interest-bearing assets like bonds. As these expectations gain traction, investors began increasing exposure to silver. Another important factor was strong investment demand. Both institutional and retail participants showed renewed interest in silver. Exchange-traded products linked to silver saw increased activity, reflecting growing confidence in the metal as a hedge against uncertainty and currency fluctuations. Silver also gained support from its dual role in the global economy. Unlike gold, silver is used extensively in industrial applications, including electronics and clean energy technologies. Expectations that industrial demand would remain stable helped strengthen sentiment and added another layer of support to prices. Technical factors played a role as well. As silver moved higher, it broke through several key price levels that traders closely watch. When these levels are crossed, it often triggers additional buying from technical traders and momentum-based strategies. This can accelerate price gains in a short period of time. Media attention and market commentary further reinforced the rally. As silver reached levels not seen before, it attracted broader coverage, drawing in new participants. This increased visibility, added to trading volumes, and pushed prices higher. However, rallies driven by momentum and expectations tend to move quickly. When too many positive assumptions are priced in, markets become sensitive to any change in the narrative. This set the stage for the pullback seen today. In short, silver's rally was built on optimism around interest rates, strong investor participation, stable industrial demand expectations, and technical momentum. These factors combined to push prices sharply higher, creating conditions where a pause or correction became increasingly likely. Today's price action carries different implications, depending on how an individual participates in the market. For traders and investors alike, context matters more than the headline move itself. For short-term traders, today's decline highlights the importance of volatility management. Silver is known for sharp swings, especially after strong rallies. Sudden pullbacks can occur even without negative news. Traders focused on short time frames often expect these moves and plan accordingly. From a medium-term perspective, today's pullback suggests the market is reassessing expectations rather than abandoning them. As long as prices remain well above previous support levels, many participants will view the move as consolidation rather than trend failure. For long-term investors, the key takeaway is that one day's movement does not change the broader picture. Structural drivers such as monetary policy trends, currency dynamics, and industrial demand evolve over months and years, not hours. Long-term positioning is typically based on these factors rather than daily fluctuations. Risk management remains critical. Rapid rallies increase volatility, and higher volatility increases uncertainty. Investors often reduce exposure during such periods to protect capital. This behavior does not imply a negative outlook, only caution. It is also important to monitor upcoming economic data. Silver remains sensitive to U.S. inflation reports, employment data, and central bank communication. These inputs will continue to shape expectations around interest rates and the dollar, which are key drivers of precious metals prices. Another consideration is market sentiment. When sentiment becomes overly optimistic, corrections become more likely. Healthy markets require both advances and pullbacks to maintain balance. Today's move fits within that process. For those watching silver from a broader market standpoint, today's action reinforces the idea that macro forces dominate short-term price movements. Currency strength, interest rate expectations, and global risk appetite continue to influence silver more than isolated supply or demand news. In summary, today's decline does not send a single clear signal on its own. It reflects adjustment, risk control, and shifting short-term expectations. How silver behaves going forward will depend on how economic data and monetary policy signals develop, rather than on today's move alone. Silver fell to 90.66 today because stronger U.S. data boosted the dollar and reduced expectations for Federal Reserve rate cuts. This made traders take profits after recent gains. If you want daily updates on precious metal prices and market drivers, subscribe and hit the bell so you don't miss the next video.